Ever wondered what exactly a stock is and why people are obsessed with the stock market? Today we'll break it down for you. Let's dive right into it. A stock represents ownership in a company. When you buy a stock, you're purchasing a small piece of that business known as a share. If a company issues 1 million shares and you buy 1,000, you own 0.1% of that company. If the company grows and performs well, your shares grow in value and you can benefit from that success. However, if the company struggles, the value of your shares can decrease, meaning you could lose money on your investment. Now, stocks aren't sold directly by the company to every investor. They're traded on stock exchanges, which are organized marketplaces where buyers and sellers meet. Think of them like a farmer's market, but instead of fruits and vegetables, people are trading shares of companies. The two most well-known stock exchanges are New York Stock Exchange, which is home to giants like Apple and Coca-Cola, and NASDAQ, known for tech companies like Microsoft, Amazon, and Google. There are other global exchanges too, like the Toronto Stock Exchange in Canada and the London Stock Exchange in the UK. In the long run, stocks have historically outperformed other investment types like savings accounts or bonds, making them a powerful tool for growing your money, if you use it wisely. So even with some ups and downs along the way, investing in stocks offers a chance to ride along with the economy's growth and put your money to work for you. When people talk about the U.S. stock market's overall performance, they often refer to the S&P 500. This index tracks 500 of the largest U.S. companies across diverse sectors and is widely seen as a benchmark for the entire market. So, how has it performed over time? Let's take a look. Over recent 5-year periods, the S&P 500 has averaged returns of around 10%, though this can vary greatly depending on the economy. Over 10-year spans, the average return is typically around 9%, showing the benefits of sticking with stocks through market cycles. The 50-year historical average is close to 8%, underscoring the reliability of the stock market for long-term investors. However, it's crucial to remember that these averages don't always reflect what investors might experience in any given period. The S&P 500 has seen some challenging times, too. During 1969-1981, high inflation led to significant declines. Later on, 2008 financial crisis happened and the S&P 500 fell 56.8% from October 2007 to March 2009. More recently, during COVID-19 pandemic, the S&P 500 dropped over 15% as the pandemic impacted global markets. These examples remind us of the importance of patience in investing. While there may be down years, the S&P 500 has consistently delivered positive returns over the long haul. That's why every investor should have an emergency fund to avoid being forced to sell at a low point and can stay invested through market ups and downs. The stock price you see doesn't always reflect a company's real value. Rather, it's often influenced by market forces and news. Here are some key factors that drive stock prices. Company performance, strong earnings, or new product launches often attract investors. Economic conditions, a growing economy generally supports higher stock prices. Market sentiment, if investors are optimistic, demand rises, driving prices up. Interest rates, lower interest rates make borrowing cheaper, leading to more investment. News and global events, political events, scandals, or global crises can sharply impact stock prices. Together, these factors shape demand and can push prices higher or lower in the short term. However, as Benjamin Graham, the father of value investing, once said, "In the short term, the stock market is a voting machine, but in the long term, it's a weighing machine." This means that while short-term prices reflect popular sentiment, in the long term, the real value of a well-performing company usually wins out. Now, how do we determine the real value of a stock? This real or intrinsic value goes beyond the market price and involves a deeper look at metrics like the price-to-earnings (PE) ratio, earnings per share (EPS), and future earnings projections, and many more metrics. By examining these, investors can get closer to understanding a stock's true value and spotting potential opportunities, whether a stock may be undervalued, a bargain, or overvalued, a risk. There are many ways to approach stock trading, and each has its unique style, strategy, and goals. Here are some of the most common types of stock trading. Value investing. Value investors seek stocks they believe are undervalued compared to the company's true worth. The goal is to buy low and hold for the long term. waiting for the stock price to reflect the company's intrinsic value. Growth investing. Growth investors focus on stocks of companies with high potential for rapid growth, often in sectors like technology or biotech. This approach prioritizes potential over immediate profitability, and investors often hold on to stocks over longer periods to capture substantial gains. Dividend investing. Dividend investors prefer stocks that pay regular dividends, which are portions of a company's earnings shared with shareholders. This approach is popular among those seeking steady income in addition to potential stock appreciation. Day trading. Day traders buy and sell stocks within the same day, sometimes within minutes or hours, aiming to profit from small price movements. It's fast-paced, requires real-time market tracking, and is often considered higher risk. Swing trading. Swing traders hold stocks for a few days to weeks, aiming to capitalize on short to medium-term price movements. It involves less frequent trading than day trading, allowing more time for analysis and planning. Each trading style has its pros and cons, and finding the right approach depends on your risk tolerance, investment goals, and time commitment. You can use free platforms like Google Finance and Yahoo Finance to track and study stocks. Here's how. First, search the company name or ticker symbol like AAPL for Apple. Then check key financials. Look at metrics like revenue growth. Is the company making more money year over year? PE ratio. A low PE ratio may indicate that a stock is undervalued, while a high one could mean it's overvalued. Dividend yield. If you're looking for income, this shows how much return you can expect from dividends. How profitable is the company? Debt levels. Too much debt can make a company risky, especially in tough economic conditions. And many other metrics that are readily available. Finally, read the news. There's often relevant news linked to the stock that could affect its price. For new investors, the idea of buying individual stocks can be exciting. Who wouldn't want to own a piece of their favorite company? But starting with individual stocks can be time-consuming, risky, complex, and stressful, especially for beginners. That's why many experts suggest building your portfolio with ETFs, exchange-traded funds, or index funds instead. ETFs and index funds are collections of stocks that are professionally managed for a small fee. By investing in them, you're not placing all your hopes on one company's performance. Instead, you're owning small shares of hundreds of companies that have been carefully chosen based on a criteria to provide broad market exposure. This built-in diversification not only spreads your risk, but also makes investing hands-off and easy to manage over time. If you're a beginner and interested in investing in the overall U.S. market without picking individual stocks, S&P 500 ETFs are a great way to get started. These funds give you exposure to 500 of the largest companies in the U.S. Here are 3 of the most popular ETFs that follow the S&P 500 index. SPDR S&P 500 ETF is the first ever ETF and one of the most widely traded. It's known for its high liquidity. Vanguard S&P 500 ETF is another popular ETF that mirrors the S&P 500. Managed by Vanguard, it has one of the lowest expense ratios in the industry. iShares Core S&P 500 ETF is another great option. These ETFs offer an easy way to diversify across sectors and benefit from the overall market's growth. That's it, everyone. The stock market is a powerful tool to grow your wealth, if you play it smart. Follow for more tips on personal finance and building a successful investment journey. See you soon.